Hey bulls and bears, what is happening? We're back with another dose of economic reality as usual. We've got a lot of big financial economic news to get into today as we continue to see the slow motion collapse of this economy in the US and mostly around the world for similar reasons, right? People are tapped out, either completely tapped out or getting tapped out or close to being tapped out on their lines of credit. Interest rates are much higher. People are not paying off their balances in full each month on those little pieces of plastic that most people have to swipe just to survive. And things are going to continue to get worse as we progress here. And we've got more huge signs of the continued downward trend in the economy and the average U.S. consumer getting worse off in a worse situation here. So let's go ahead and get into it here. I've got a new chair, by the way, so I was a little more leaning back in my previous videos because I didn't have my proper chair. I've got a new chair. I had to wait for it to get delivered off Amazon, but it's pretty nice. It's got the reclining function. It's got the headrest. So when I'm have those long days in the office, so I'm a happy camper with my new chair. But anyways, let's get into it. The Dow Jones up 0.3% today. The big gainer today was actually the NASDAQ up 1.5%. What was the good news? Well, the good news was talks on the debt ceiling. The markets know, investors know that it's all about the debt. Once America can no longer go into endless debt, then it's the end of the ballgame. That's why when you see negotiations, you see a lot more stresses and fear enter the markets because there's always that fear that there's going to be either a delay or a non-passage of the debt increase. Now, I've always said here, I think it's always going to be increased. There may be some delays and some drama, but behind the scenes, none of the powers that be want the debt ceiling to be stuck. They want it to be increased. In fact, they're trying to eliminate any negotiations, and they want the power to just increase it without any discussions or negotiations whatsoever, which is crazy, but not really surprising when you look at what's happening right now. Here's something, though, that's pretty huge. Target is out there warning, and we warned everybody about this over 2 years ago, probably even more if I look back, that as the economy continues to deteriorate, thefts and these situations where people run into stores and loot and rob and steal are only going to get worse. Target CEO, we're seeing violent incidents in our stores, and it's costing us millions of dollars. So that's something else on top of the rising cost of living, on top of the higher taxes. Now you have to pay for all the thefts because what are the stores going to do? Are they going to close down? Well, some of them will. Look at all the Walmarts that closed down around, I believe it was the Chicago area, right? Several of them. Also, Portland no longer is going to have any Walmarts. We did that report, I think, recently. It was either Target or Walmart. I had to look. That was a couple months ago. But what's happening here with Target is a huge inventory shrinkage because of all of the thefts. And it's no coincidence that these thefts increase, these situations increase where people are running into stores, sometimes in mobs. Other times it's just an overall rise in theft. It's no coincidence that this increases when the economy deteriorates. The more debt people are in, the more they're going to be tempted into entering a life of crime or to do these types of acts here. Mostly theft of merchandise, which costs a whopping $500 million for the store. This is Target. $500 million each year. Target is on pace to see 1.2 billion in profits go up in smoke due to primarily crime. The CEO said, quote, "The unfortunate fact is violent incidents are increasing in our stores across the entire retail industry, and when products are stolen, simply put, they can no longer be available for guests who depend on them. Left unchecked, organized retail crime degrades the community, as we call home. As we work to address the problem, the safety of our guests and our team members will always be our primary concern. Beyond safety concerns worsening, shrink rates are putting significant pressures on our financial results." End of quote. So you know what that means. That's going to be higher prices. They're going to raise the price on the other merchandise to make up for the losses over here. Pretty simple to figure out. It's going to lead to higher price, higher cost of goods. Now, a lot of people expected the price of merchandise and items at these retailers, these big chains, to crash because the big overstock that they had from 2020. Well, we're not really seeing a big crash in prices, and this could be something else that prevents the cost of these items to come down. Is this massive increase and theft. In the meantime, many people are looking at earnings of these companies. But as far as investing in stocks, take a look at Target stock. The peak for Target stock was right around November 2021. It was at $260. We're now down to $154. We're $100 off per share of the stock price. So things are not looking so good for people that bought at the top there or near the top and are still holding this stock. In fact, you'd have to go all the way back to early 2020 to get down to where the stock price is at now. So we're at pandemic levels as far as the stock price right now, which is that a positive thing? Well, apparently people think that rising crime is good because the markets were up today. But tell me what the good news is and why the markets really should have been up. Now, let's transition a little bit here. Commercial real estate, we all know that commercial real estate prices were in a bubble. Things are very slow moving in commercial real estate. Finally, we're now seeing, though, commercial real estate prices in the U.S. fall for the first time since 2011. Now, this is the national number. We've already witnessed some big declines in some major metropolitan areas, like in Manhattan, San Francisco, huge declines over 50%. But now the entire nation, when you take all the different areas on an average, are declining for the first time since 2011. But people out there still doubt that things are changing, that things are going in the wrong direction. As we talked about in my last video, I've got some serious doubters that email me from time to time telling me that I'm wrong. Well, I'm reporting the news, so how can I be wrong? So Bloomberg is reporting this. Commercial real estate prices fall for the first time since 2011, and other publications are reporting it as well. So instead of saying I'm wrong, why don't you go email Bloomberg and tell them they're wrong and tell them their numbers are wrong, because this is where I'm getting the data. U.S. commercial real estate prices fell in the first quarter for the first time in more than a decade, according to Moody's Analytics. So go ahead and go right to the source, email Moody's and tell them that they're wrong. Say, no, you're wrong, the economy's fine, prices are not falling. The decline was led in drops by multi-family residences and office buildings. So even multifamily residences are dropping. So with the falling values, what are they going to do? Are they going to raise rents even more? Very interesting. So the more consumers get tapped out, deeper into debt, the more there's going to be calls for more rent protections and things like that. So it's not a very good place to put your money right now in multifamily residential real estate. What if you buy a huge multifamily building and all of a sudden your city or state passes a law that you can't evict anybody, so then people stop paying their rent? So who's going to be there to help you if that happens? So that's got to be one of the reasons, but there's many reasons. Now, with these declining prices, think about the banks that gave out loans for many of these properties. These banks are going to have undervalued assets on their books. They're going to have a harder time finding a buyer for this debt, for these bonds, and it's just going to snowball. And this is going to be another thing to kick the legs out from under a lot of these banks, and definitely not a good sign as far as the bank failures and the insolvencies that we're seeing and that we're going to continue to see. All right, let's transition a little bit here into some more supposed good news. Well, the good news was that U.S. weekly jobless claims fell. That's the headline. It makes you think, well, the economy's doing great. Weekly jobless claims fell. When we get into the headlines, the true story is they fell more than expected. So all they have to do is pick a number that they say, oh, we expected this, and now it's this. This is great news. It's worse than expected. But when you look at the numbers, weekly jobless claims drop to 242,000. That is for a week, 242,000. So we're still at almost 1 million per month. Just multiply that by 4, and you're close to 1 million. And ask yourself, the people that are losing these nearly 1 million jobs a month, are they going to better jobs? Right? All these tech layoffs and all these companies laying people off, are they going to better jobs? Or are they going to lower paying jobs? And are they able to find a full-time job? Maybe they're working 2 part-time jobs, but remember, that gets chalked up as jobs added. So that's why you see this jobs added number not look too shabby, for lack of a better term, because that's what's happening, folks. And most people don't realize it. They just look at the headline and they don't really look into it. So that's what I'm here for, to kind of get into the gory details for you. And also, you might want to ask yourself if these jobs that people were going to were so great. When you look at the jobs added numbers, why are we still seeing enormous surges in credit card debt, right? And they're telling us inflation is coming down, right? When you look at the prior month, it came down a little bit, but when you look at year over year, it's still up. And even when something comes down from an already elevated number, it's not really good news. And again, if it was that great that inflation's coming down from one month to the next, why are people still getting so much further deeper into credit card debt? It's pretty simple, folks. It's not rocket science. We can see what's going on. We see the writing on the wall. In the meantime, it's going to be harder and harder to get by for the average working person. We know that a lot of the wealth that was created over the past couple years was mostly in the top 10% and mostly even in the top 1% when you want to drill down a little bit deeper. All right, so it's getting more difficult. If you're already a billionaire, no problems. If you're already a multi-millionaire, no problems. Even if you're a millionaire, though, there could be very difficult times ahead. $1 million is not what it used to be. Being a millionaire is not what it used to be. And I know people that are worth $1 million on paper, and they're afraid to quit their job. They're afraid to stop working because they know that if inflation keeps going, the cost of living keeps going, $1 million is not going to get you very far. And if you have family, you want to set your family up. You want to set the next generations in your family up for success. You want to leave them something. So there's people in their 60s, 70s, even with $1 million net worth, that are continuing to work because they feel like the $1 million is not enough anymore. It's crazy to even talk about that, but that's the true and reality of what's happening. And then on the other hand, you have people that are so broke, they're forced to work. They have to work just to make ends meet. We're seeing more older people now staying in the workforce or going back to work and unretiring. I see that more and more now as I go into grocery stores and just around doing different errands. I'm seeing more older workers. Speaking of layoffs, California layoffs jumped 60%. 60%. So, of course, this is the tech hub out here in the Bay Area, Silicon Valley. That's part of it. But overall, layoffs in California up 60%. That is a 27-year high, folks. A 27-year high. But again, people out there say everything's normal, nothing to see here, no problems. This is just doom and gloom. This is just fear-mongering. We know the truth, folks, so get ready. The storm is upon us, and the clouds are getting darker. Keep stacking because you're going to be glad you did. Thanks, everybody, for being here. Big love. Bye for now. Peace.